Welcome to the Market Mosaic, where every week we are taking a look at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to gauge where the market could be headed over the near term. We're looking at the end of 2025 here, and so I want to start with seasonality this week, and more particularly the Santa Claus rally, the period that runs through the last 5 trading days of the current year and the first 2 trading days of the new year. And if you want to plot out how that looks historically, that's what this chart does from Subaru Trade. This looks going back to 1950, those Santa Claus rally periods for the S&P 500. And if you look at it all together, just over that 7 day stretch, you get an average return of 1.26% with a percent of time that period is positive at 77%. So that's why we refer to this as a historically strong seasonal period for the S&P 500. We tend to see high average returns along with a positive hit rate. But the thing that you want to keep an eye on this year, so we start this Santa Claus rally period here this week, and the thing you want to keep an eye on this year is, look, we've had 2 back-to-back years, 2023 and 2024, in which the Santa Claus rally did not deliver. Santa did not deliver presents to Wall Street. And if you look back historically, we've had two other instances of back-to-back declines during the Santa Claus rally. We have never gone 3 years in a row. Let me repeat that. We have never seen, using data back to 1950 at least, we've never seen a 3-year stretch where the Santa Claus period delivered negative returns for the S&P. So we're off to, potentially off to a really nice start. We've had a really nice start to the week, and we'll see if we can carry that momentum through during this favorable seasonal period. But if we're going to see that Santa Claus rally show up in the final week of 2025, the first couple of days of the new year, you need the Mag 7 to show up. And this is something that's been really interesting to watch really since late October. Since late October, you have seen a number of the largest stocks in the market pulling back, which is weighing on the S&P 500, while the average stock's actually been holding up really well. So if you were just looking at the S&P 500 since the peak in late October, and we're back near that peak, you would think the index has just been chopping sideways, struggling. Well, the average stock's been doing really well. The problem with the S&P 500 is that the top 10 names, if you track this brownish orange line on here, this tracks the weight of the top 10 names in the S&P 500. This goes all the way back to 2000. You can see this actually really started to take off in 2016, but has really accelerated since the aftermath of the pandemic, and especially since this point right here. This is about when this current cyclical bull market started in late 2022. Since then, you can see that the top 10 stocks in the S&P, using the scale on the right, over 40%. This is the highest concentration in the top 10 stocks in history for the S&P 500. And so we're entering the Santa Claus rally period. It's a favorable stretch for the market. But as we've seen over the last couple months, if we don't get the top 10 names to show up, especially those key members of the Mag 7, it's really hard for the capitalization weighted indexes to sustain a rally. We've seen positive trends under the hood, but the broader indexes themselves are very much exposed to what is going on with those top 10 names. All right, I want to talk about one thing that could rattle the markets, rattle investors a little bit heading into 2026, and that is with the bond market. It's really interesting what we're starting to see unfold in some other corners around the globe. We've seen a big backup in yields globally, whether it's been Germany, but then on here I'm showing Japanese bond yields. So Japanese bond yields on longer term bonds, the 10-year, this light brown line, and the 30-year, this dark blue line. And I think this could be a preview of bond market volatility, things to come in 2025, and where this would really start to impact things as you see these kinds of moves start to happen in the market for U.S. Treasury securities. And I'll get to that in a second. But you've got the catalysts that are in place that are driving this. You can see those same catalysts here domestically. So This isn't something new. You can see that bond yields in Japan bottomed out and really went nowhere for about a period of 5 years, 2017 and 2022. But then, and since then, has really started to pick up and then accelerating more significantly recently because of a new prime minister in place that campaigned on part of it being fiscal stimulus. When they pass that fiscal stimulus package, they're going to have to borrow more to put that into place. And so, so who knows what's driving this back up in yields? I mean, you could say concerns over Japan's public finances now that they're borrowing more for the stimulus package. Is it potentially optimism over the growth outlook? When the outlook for positive GDP growth is really strong, you'll tend to see longer end bond yields rising. Is this concerns over inflation? So whatever the case may be, we've had a huge backup in longer dated yields. The 30-year yield, again, for Japanese government bonds is at the highest levels ever seen. And so we want to watch for, this bond market volatility, if there's a spillover effect impact to the stock market. We want to watch if that bond market volatility hits in the U.S. here as well. And there's several catalysts in place that could cause this. I mean, we continue to run large deficits relative to GDP, even though we're in a period of time where the economy is growing. You tend not see such large deficits when the economy is expanding. Deficits tend to kick in when like back in the pandemic or during recessions, as stimulus pass and automatic stabilizers kick in. We're still running large deficits relative to GDP. The debt to GDP ratio is right around 100%. The one thing that you want to keep an eye on this year, and a lot of people are talking about this, is there is this huge wave of treasuries, U.S. government treasury securities that are maturing this year, and that must be refinanced. So these bars on here, this is showing how much the total outstanding U.S. Treasury debt is maturing in any given year. And you can see in 2026, over $8 trillion. Actually, I think this is over $9 trillion, around $9 trillion in U.S. Treasuries is maturing this year. That's right around a third of the total Treasury debt outstanding. And so this, in addition to deficit spending, which means new borrowing needed, there are previously issued debt instruments that are maturing this year that have to be refinanced as well. A lot of the stuff was issued around the pandemic, coming out of the pandemic, to fund stimulus measures back then. And, rates were near their lowest points in history then compared to where we are today. So watch for this to be, a potential spark for some volatility in the bond market, and we'll just have to monitor how that volatility could spill over into the stock market. Another thing to be aware of heading into next year is that we are finally starting to see positioning getting stretched to bullish extremes. And so what this chart on here shows, this comes from Bank of America. They do this global FMS. This is a fund manager survey. They conduct this once a month. They ask a lot of different questions, and then they release the results. But one of the things they'll do is they've created this blue line on here is this composite percentile rank combining for fund managers. So these are institutional money managers. So for fund managers responding to this survey, this is ranking what they expect for growth, their cash levels on how they're allocating. So low level of cash would imply high level of bullishness, and on the flip side of that, their equity allocation. So a high equity allocation would be reflecting a bullish view. And they're like CNN's Fear and Greed Index gets a lot of attention. The AAII survey of retail investors gets a lot of attention. Those are surveys asking how people feel and whatnot. I put a lot more weight into actual positioning. So this survey should reflect cash and equity allocation. So it's a better reflection of sentiment, in my opinion, when you're picking up on how investors are actually positioning. And you can see we've had a quick rise higher from the pullback in the trade war in this indicator, indicating too much fear in the market, which is a good thing. It's a contrarian indicator. Now we're coming into starting to finally see too much bullishness, too much greed. Again, as a contrary indicator, you want to be on the alert. Now, there could be more to go on this. You can see we're not quite to levels that have marked some other important peaks in the market, but definitely something to be aware of as we head into 2026. One area of the market where we could see some really great trading opportunities, or even just more of an allocation buy and hold type strategy is with the average stock. And I think one of the best places to look when you're looking at the average stock is with mid-cap securities. So you break the universe down into a large cap, mid-cap, small cap. Mid-cap is kind of in that sweet spot between large caps and small caps. And we know, what's been going on with the S&P 500 in terms of the Mag 7 really driving the index, becoming a huge portion of the index, and as a result of that, also driving the S&P toward very, very stretched valuation measures. And what this chart does on here is it takes the forward PE ratio of the S&P 500 relative to mid cap. So it's a ratio of the PE between large caps and small caps. So when it's falling, that means the large cap PE is rising more quickly than the mid cap PE. And look at where we are now. We are back at levels last seen heading into the internet bubble. And if you want to go back and look at this period, look at what, especially on the value side, look at what small mid cap did in the aftermath of this. While we had a big collapse in the S&P 500 and the NASDAQ, smalls and mids, especially during the early stages of the bubble bursting, small and mid caps on the value side in particular performed extremely well. And I think we could be setting up something similar this time around as well. If you start to see some volatility come into large cap names, if that starts to weigh on the S&P 500, it's going to look like the market's doing terrible if you're following the S&P 500. Meanwhile, you could see mid caps and the average stock holding up really well. And again, this relative valuation would maybe support some mean reversion there into the mid-cap space. So we're getting another batch of economic data this week. Some of this has already come out. The big reports to focus on would be the third quarter GDP number and the corresponding PCE price index, the personal consumption expenditures price index. That gets a lot of attention because it's the Fed's preferred gauge. And look, there was some great news out of the GDP report. GDP growth coming in at 4.3%, well ahead of expectations. If you look at where the current quarter is estimated at, if you use the Atlanta Fed's GDP Now model, that's at 3%. So we're content for the fourth quarter. So continuing to see GDP growth coming in really strong, holding up really well. At the same time, this the core PCE price index for the third quarter, I would pay attention to what it did during the third quarter. It came in at 2.9%, which was in line with expectations, but 2.9% is still well above the Fed's 2% target. And this is an area where I think you're going to see a lot of volatility come into the market in 2026 is questions around the Fed. If you are the Federal Reserve, it's tough to justify rate cuts when you have quarterly GDP growth coming in over 4%, but your inflation figures coming in at 2.9%, well ahead of target. So that's going to be questions around the Fed is going to continue to be a major issue, a major theme for investors in 2026. One trade idea I want to keep an eye on, especially if we start to see this Santa Claus rally unfold. This is kind of an overlooked name that is really leveraged to some of the trends in artificial intelligence, being able to leverage that to their advantage, and that's with the Reddit ticker RDDT. And we've got a really prime setup developing here. What I would watch is if you look at this initial peak back in February, we took out that level around late summer and started to pull back. So what this starts to look like to me is a base on base pattern. The key support level that really comes into play is where you had this gap above the 150 level here back in July. And you can see this gap area that's been serving as price support on this most recent pullback. So price is pulling back, resting on that support level, but now we're coming back up to the prior highs once again. So if you look at the prior highs around this 275, 280 level, we're within proximity of that. We're getting a bullish MACD momentum reset here. So what I would watch for, I would initially watch for this 250 level. So that's pretty close to this most recent tight trading range that we've had in December. If we can start to see a strong move above 250 initially, followed by new highs, that could be a very key breakout, tradable breakout in Reddit right here. We'll look for confirmation by a large volume bar along with this relative strength line out to new highs as well. Those will be confirming indicators on a breakout. All right, that is all for this week.